Good morning, all. I hope you're all well and have had a lovely week. This week has been a lot like the recent weeks gone by. A lot of volatility, a lot of impulsive moves, and of course, fundamentals damning market participation from an investor sentiment. Broadly speaking, this week's narrative, that super high inflation that we talked about on Wednesday, followed through with further weakness into yesterday. Now, the last 36 hours or so, 48 hours or so was fairly consolidated into last night's Asia session, and we have seen those markets decline even further. So we're still very much seeing that risk aversion, investor sentiment out of riskier assets like stocks, equities, indices, and into the traditional hedges like dollar, where we're seeing that dollar strength this morning into the end of the week. I think it's going to be a very, very interesting week because we've seen discussions with Xi and Putin in Ukraine, in Russia and China. Nothing regarding Ukraine was even mentioned, which is a little bit interesting. And of course, the new pipeline from Russia to China has been launched as well. So they're expecting that to supersede that of Nord Stream 2, which is the main pipeline into Europe. Again, I suppose with the risk aversion, with the news regarding the rail strikes in the U.S. is definitely going to be important in the coming weeks, because that could potentially give more investor sentiment, particularly to the downside, with the freight workers being on strike. So these elements are definitely worth taking into consideration. And we're seeing that very, very clearly. We're seeing indices, as I said, take lower. We're seeing the FX pairs, the dollar pairs, continue to remain quite strong. Dollar currency at the moment is still the hedging bet amongst institutions and professional traders. Now, that aside, if we look at the market participation this morning, we can see that dollar impulsive moves, particularly on the 1 hour, 4 hour, broke out of yesterday's short-term consolidation and is turning higher. So from our perspective now, it would be interesting to see, do we see that dollar strength into the end of this week, into this afternoon and into tonight's US close? Or do we see some sort of top out on rejection at the top? Now, at this point in time, sentiment is still very much aiming and projecting that move higher. But from my perspective today, I'll be assessing the price action into, as I said, the US session open today at 2:30, but also that close tonight, that all-important close to determine how do we get those weekly closes. If you dial up to the DXY on the weekly, it's going to be a very, very important week for the DXY, because we can see broadly we're still getting those bullish closes, pullbacks, and we're still getting those impulsive moves to the upside. Now, the move last week was a very, very clear rejection at 110. So into today, that's going to be the fulcrum point. Is the price action going to break through that 110 level and take out that weekly wick, establish that 111 last week? Now, at this moment in time, dollar is still at 110.16, so it's still some way to go to take out last week's wick high. However, at this moment in time, it's doing its very best to do that. So the daily closes, the weekly closes, even the 4 hours will be interesting for those higher time frame traders. If you're short-term scalping, well, then obviously that's not taken into consideration as much, because you're looking at the short-term price action and nuances within that. And that's obviously a very, very different style of trading. Okay. Now, when we look at the euro dollar, we're still seeing those declines from that week high last week at 102. We've seen the price action top out here at 102, that initial impulse on Tuesday off the back of that CPI into this consolidation. And we can see now the euro dollar is starting to slide again. So we've gone from that parity level around $1 or €1 to the dollar all the way into this 99.50 level, where we're currently finding some short-term lows this morning. Okay, so it'll be interesting to see how does the market react into today's close, and more pointedly, does the markets actually take out these lows that was established way down here last week at the 7th of September. So 91, given that we've now broken through parity, I think 99 is going to be an interesting area to see. Is there any sort of market reaction off this zone, or do we continue to slide through? If we continue to slide through, well, then that sets up a very, very ominous and bearish reaction this week into what could be a very, very interesting week next week, given that we're starting to see the Fed coming through on Wednesday with its next interest rate meeting, and of course then setting a tone for the CPI. So on the back of the CPI, we got those higher numbers, and of course then moving towards the FOMC on Wednesday, as we said. So that brings us in to, I suppose, the cable. Looking at the cable, unlike the euro dollar, has actually taken out those recent lows here at 114, 114.50, and is actually continuing to slide. So on the 4-hour order flow, still very much bearish. We got that pullback, creating another lower high into that 117 handle. Very, very clean sell-off on Tuesday. A little bit of a dead cat bounce or short-term recovery. So dead cat bounce is a short-term recovery in price action. And we can see how that's slid all the way lower. Bearish order flow, took out Tuesday's lows and has continued to descend lower. And at this point in time, we've now made new lows again on the cable under 114. So that is also insinuating further bearish sentiment, at least this morning anyway, and of course into the early parts of potentially next week. So all eyes will be really, how does the dollar close today? Are we bearish? Are we going to continue that kind of elevated downside approach in price action? And of course, setting that tone normally. Now, next on our list is the 10-year yield. Now, this is something I don't normally look at, but I thought it was quite interesting because on the weekly, on the daily, we're coming into that 3.5% level. Now, normally speaking, yields is quite interesting because the crossover, the inversion of different yields, so let's say 2/10s, gives us a very strong recessionary indicator, and we can see that the inversion has taken place again. However, the differential between the 2s and the 10s and the 2s and the 30s fell actually on Wednesday to Thursday by 19 basis points, which does indicate a soft landing. But at this moment in time, can we actually definitively confirm a soft landing when we have ultra high inflation, we have negative growth globally coming now shortly, we have a very, very difficult earnings season coming through, and of course we have weaker retail sales and lower home price and new home sales figures as well. So all of these different indicators are all insinuating that markets aren't taking the second half of this year anywhere near the Fed and I suppose governments would have liked. And of course, we're seeing that factor through into the price action with where indices now are very, very close to market lows. Now, just before we look at the indices, I do also want to look at gold. So gold has completely blitzed through this 1690, 1700 handle. So this was kind of the last area of support from my perspective to see could the markets actually hold through. And lo and behold, we've actually seen the markets break off and continue descending lower. So at this point in time, this is a larger run gold chart over the last, I suppose, 2.5 years or so. And we can see that very, very clear Wyckoff nearly accumulation structure. You can kind of see it here, all the ebbs and flows, massive Wyckoff structure, double tops liquidity way up here, and then of course melts off and is obviously taking the liquidity on the downside. At this point in time, it's really a case of all eyes really on gold prices, because we know commodity prices are getting absolutely smashed at the minute. Oil prices are continuing to make bearish order flow for the last 12 weeks or so. We're seeing commodity prices come down. We're seeing silver, gold. We're seeing all of these different markets all circulate to the downside. And that's, of course, obviously off the back of the rising interest rates and cut in demand. So normally speaking, when you get commodity prices selling off, that's effectively basically saying that there's been a complete shift in the demand side cycle of market participants. So obviously, with a reduced volume of demand means that there's a lack of interest or want for it. And then, of course, as a result, the markets completely fall in reversion to kind of what we would have saw in the stock markets in the first 6 months of this year and obviously to date as well. So that's kind of where we are in gold. Gold has continued to break through. It's taking out these current wicks here at the minute. And I suppose it'll be interesting to see, does it close below the 1700 level at this moment in time? I would probably put the money on it that it will do, because we are sitting at 1660. However, we'll probably look for that new low to be formed and then relief rally back into this 1700, 1710 level probably next week. So let's just wait and see. Obviously, market participants are obviously pricing in 75 basis points. So you're going to see those bigger institutions getting in now ahead of the Fed on Wednesday. It won't just simply a case of we'll sell on Wednesday, we'll buy on Wednesday off the back of the FOMC. All of these larger institutions are pre-pricing in ahead because their analysts are forecasting a very hawkish and aggressive move by the Fed on Wednesday. And as such, market participants, should I say, are taking it in the same manner. Now, again, oil, similar scenario from oil. It got that very nice dead cat bounce recovery, that V-shaped bottom, all the way into this kind of 89, 90 level. I had looked at this area up here around 93 to see if there was any sort of pullback this week, but of course, with that CPI figure coming out much more aggressively than people would have liked. We didn't get that allocation or that ability for the price action on oil prices to come back into this 92, 93 level. And at this point in time, we have broken back underneath the short-term bottom here around 86, and it's trading in the 84s at this moment in time. So oil prices, commodity prices, broadly speaking, still getting absolutely hammered here at the minute, and consensus is for a potential of further declines. Now that only helps particularly those on fuel prices and energy prices. The weaker commodity play will obviously soften the blow for households, those who are working, and obviously those household bills as well. But of course, we want to see a more sustained move in that regard. Last but not least then is our indices. So the indices is completely sold off across the board. S&P's has made new lows, so that structural 4-hour bounce into that key level at 4100, 4150. Very, very clear reaction. We've now broken through those lows from Tuesday, and we are declining. So that brings us back into this 3750, 3800 level, and that's what I'm focused on now. Unless there's kind of some sort of very quick shift in sentiment over the weekend, I would imagine that the price action is probably going to try and take us into these areas down here into next week. And again, that's what I'll be looking at personally speaking. Similarly, again on the Nasdaq, we too have also broken the lows here. Let me just remove that of the 12,000 area. We've completely blitzed 12,000. We're now sitting underneath 11.8 as price action makes a return back into these lows, which of course was the June bottom that formed before we got that very, very aggressive July and August market rally. So at this point, markets very, very quickly to do that U-turn. We can see it there, the order flow very, very clear. Bearish order flow, lower highs, new lows, lower highs. Bearish order flow breaks the structured lows, and we're continuing to turn lower. So the sentiment is what it is at the minute. And of course, not to leave out the Dow Jones, very, very similar and aggressive move. Bearish order flow, rejection of level here around 32,500. Nice psychological round number. Got that very, very clear initial sell-off into Tuesday's low, or the September lows on Tuesday. And then, of course, we hung about. So Tuesday evening, all of Wednesday, all of yesterday was very, very consolidated. There really wasn't much movement. And of course, then overnight, we started to see that market selling off late last night into the U.S. close. And we've seen that continuation this morning as price action continues to move lower. So from yesterday's range, we're probably sitting somewhere around about 500 points down on the Dow Jones, which is another around about 1.5%. And of course, since Tuesday's highs, if we look at the daily price action for a moment, and we look at where we were on Tuesday from Monday's close and do the percentages just very, very quickly, we can see at present time, the Dow Jones is just down a modest 5.3% for the week from the open. So from Tuesday's market open, or for the rollover, should we say, to where we are currently, a modest 5.3% decline on the Dow Jones. So we're seeing that similar decline across the board. S&P's very, very similar, and of course Nasdaq also the same. Now again, Europe isn't really much better. FTSE got that nice rally back into the 1700 order block level that we've kind of talked about. Complete and utter rejection, complete and utter capitulation, all the way back to the 7250 level, and that's something that we did mention earlier this week, that I would be looking for a revisit of this area here, 7250, and of course we have got that this morning. Now we have seen a little bit of a bounce in the FTSE in comparison to its compatriots in the US, but broadly speaking, market developments here is that the FTSE has obviously led the way initially in the week with that steady decline. So in the US, we obviously held those lows on Tuesday, whereas the FTSE continued to move lower. So fundamentals in the UK slightly more bearish. Unwind of that buying last week, Thursday, Friday, after the Queen's passing, and of course we had that significant sell-off on Tuesday and Wednesday of this week, where we found that consolidation both continue to kind of grind lower, creating that bearish order flow. So we're still creating lows. So you've got your lows here. If I just get my drawing pad, we've got lows here, we've got new lows here, we've got short-term consolidation, lower highs, and now we're pulling back for another lower high. So I would expect maybe a 73 revision, watching the order flow around this region, and then of course assessing to see, is there a third drive lower. So we've kind of got, if you're looking at price action there, you kind of have wave one, you have a pullback, you have wave two, we're getting that pullback. So we're probably going to get the likes of wave three, and then see if there's any sort of cyclical correction next week. Now, of course, that might necessarily happen, but we are in the process of this second wave correction, and then of course third drive lower to see if there's any sort of materialization in that trend as well. And of course, not to leave out the DAX in Europe, we're seeing the European markets continue to get hammered lower. Very, very optimistic on Monday. Of course, that was very quickly undone with the bearish engulfing on Tuesday. We had that 4-hour consolidation, but we've seen the initial consolidation become undone because of the fact that the price action has just continued to kind of grind lower. Still continue to grind lower, holding on, and then bang, breaks through yesterday, and then we get that continued decline into today, and the markets are revisiting those lows down here. So this 11.6 handle is 11.5, 11.6 is worth keeping an eye on here today to see how does the markets close. Could we see the DAX completely break this consolidation range? Because if you're looking at this broader range, you're seeing again very, very quickly bearish moves. So every time we get any sort of recovery in the DAX, it's hammered in with another wave of lower. So it really just becomes a case of how does the DAX react around this 12.5, 12.6 level, because if that goes, ultimately you're looking at an even deeper slide, a new fresh set of lows, and of course the bearish cycle from the beginning of the year continues as the DAX completely unwinds. Now at this moment in time, of course, we then have to go back to some of these low weekly levels of interest, and of course there is an area here around 11.5, which was kind of where we started to really sell off through May, and we had that initial sell-off and then we completely gapped down, completely unwound. So that becomes interesting to see how does the price action react. But again, still quite a distance away, still quite a time away, and of course it just becomes a case of short term, how do these markets react at these lows as well. So that's pretty much it for the week, everyone. Hope you all have a lovely weekend, and we'll see you all on Monday to preview obviously next week the volatility, and of course we have central bank next week as well.